Hello, this is Professor Richard Holizak from Baruch College. I'm here today to talk to you about our price discovery trading simulation case. Three things that we'll do today are talking about information and how information is spread through markets. We'll talk a little bit about some trading strategies that you might consider given information that you have on the markets. And finally, the mechanics of how we put those strategies into action. So the motivation for this trading case comes from the idea of analyst recommendations. And so what I've done here is I've brought up a Bloomberg screen that's looking at the analyst recommendations for Microsoft stock. And I know it's a busy screen, there's a lot going on, but the few things that I want to point out to you, at the time I took this picture of the screen, Microsoft was trading at about $43 a share, a little bit more than $43 a share. If we look down here at the bottom portion of the screen, what we can see are a collection of analysts who are following Microsoft stock. And so all of these individuals become experts on Microsoft and their industry, what makes a good product or service in that industry, whether or not that industry is growing or shrinking. And then they apply all of that industry knowledge to a company like Microsoft and they make some recommendations. So, what are some recommendations you've all heard analysts make? Well, there might be a buy recommendation, like this person at Evacor. They might be hold recommendations, or they might even be sell, or in this case, reduce recommendations. The other thing that I want to point out to you is that often analysts will give a target price, and that's in the next column over here. And so, if you remember, we looked at Microsoft stock trading at about $43. And here the analysts have each given a target price at which they think that Microsoft stock might achieve. And so in some cases, they're as high as even $58. And in others, they are as low as $38. And this is just one page full. If you are on a Bloomberg terminal and you get this screen, you can page down and see a whole variety of prices. And so, what's the lesson here? Clearly, these analysts do not all agree on what the stock price for Microsoft should be. And so, one question you might ask yourself is, well, which of these analysts might be correct? Which of these analysts is going to be close enough or good enough to really predict what the actual stock price of Microsoft ought to be? Just like the case with Microsoft, in our simulation, our target company is going to have 5 analysts who follow the company. Each of those analysts is going to have a price target. For example, Analyst 1 has a target of $20, Analyst 2, $22, and then all the way up to Analyst 5, for example, who has a price target of $28. In our simulation, you'll learn that 3 of these analysts will be incorrect. You'll be able to discount their price targets. For example, you might learn that Analyst 3 is incorrect, so the final price could not be $24. You might learn that Analyst 4 is incorrect. In that case, you know that the final price would not be $26. Analyst 1, if you learn they're not correct, then the final price would not be $20. So the trick is, at the end of the simulation, one of these 5 analysts are going to be perfectly correct. And what your job is to figure out which of the final prices it's going to be. So again, you'll be told 3 of the analysts who are not correct. Your job then is to determine what the final price would be. Let's take an example. We know that we have 5 price targets, and we know that 3 of the prices cannot possibly be the final price. So our question that we're left with is our final price $22 in this example or $28? Well, let's assume that as you receive this information from the market, you look at the price trend, and we can see here the price started a little over $23 and has trended down over time. So that by the time we have all 3 of our pieces of information, we see that the stock is trading around $22, we might say. So the question would be, is it possible that we can discount that the final price would be $28? In other words, given the 3 pieces of information that we have, not 20, not 24, and not 26, and the fact that the price is trending down around $22, that might lead us to conclude that we can discount the $28 price, and therefore conclude that the final price might be $22. So again, we're using information that we're given plus the direction of the market to determine whether this $22 price might be the final price. Let's take the same scenario again though. Again, we might be told that it's not 20, not 26, and not 24. This gives us, again, our dilemma. Is it a 22 or a $28 stock? Only in this scenario, we see somehow that the market is trending upward. So up through $24, up through $25, and it looks like this trend may continue. Perhaps in this scenario, we might use the movement of the market to conclude that maybe $22 is not the final price, and that maybe this stock is headed up to $28. Again, we're given the facts that it's not 20, not 24, not 26, and the fact that this market is trending upwards well above even $24. We can maybe infer that the final price might be $28. So, in conclusion, if we consider the information that we get from the market, the fact that certain prices cannot be the final price, and the movement of the market may give us that fourth clue that we need to hone in on a final price. Now we need to come up with a trading strategy that we can use to take advantage of that information. The first trading strategy we want to talk about is what's called taking the long position. If you believe the final price in the market will be higher than the current price, then you'll want to buy. We call this going long. It's the classic buy low, sell high, and try and lock in your profit. The other way we can do this in the simulation is we can buy and hold our shares, and then we can capture profit at the end of the case. Either way, whether we actively buy low and sell high during the case, or whether we buy and hold, if we expect the final price will be higher than the current market price, we should profit from the long position. So for example, if we believe the final price is going to be even higher than where the market is right now, this would be an example where we'd want to take the long position. How would we go about doing that? Well, let's assume the market is trading around $24 a share, and we decide to buy 1,000 shares. In that case, our cash position would go down by $24,000. As a side note, we're going to ignore the trading fees for a minute here. So our cash position is $24,000. We need to purchase 1,000 shares at 24, so that's going to take $24,000 out of our account. However, what we get in return is we get 1,000 shares of the stock. Now let's assume the market moves up to about $25 a share, and we decide we want to lock in some profit. We can sell 500 of our shares at $25 a share. What will that do to our cash position? Our cash position, which was minus 24,000, gets $12,500 added to it. The 12,500 comes from the 500 shares that we sold at $25 a share. So that brings our cash position up to 11,500. What about our share position? We had 1,000 shares and we sold 500 of them. So now we end up with 500 shares left. In this case, we can conclude that our realized profit and loss, that is the amount of profit and or loss that we've locked in, is $500. We think about it this way. 500 of those shares we bought at $24 a share. We've sold at $25 a share, so we've now locked in a profit of $500 a share. We have an additional unrealized profit of $500. We still have 500 shares and the market is up about $1, but we haven't actually locked this in. So we call this the unrealized profit. Now let's assume the market's moved up even further, let's say to $26 a share, and we decide we want to take profit again. We're going to sell the remaining 500 shares. And so what do we get? For our cash position, it was 11,500. We add to that 13,000. That now gives us a positive 1,500. We go from minus 11,500. We add the 13,000 we get from selling 500 shares at $26 a share. and that now gives us a cash position of 1,500. If we look at our share position, it's now down to 0. We began by buying 1,000 shares, we sold 500, and now we've sold the other 500. So our share position is now 0. How about our profit and loss? Now we have a realized profit of $1,500. We've locked in that profit. Our position is now 0. Our unrealized P&L is 0 because we currently have no open position. So there's nothing left outstanding. So now we've successfully executed the long position. What are the risks of the long position? These should be fairly intuitive. Suppose we try to do the buy low, sell high, but after we buy low, prices continue to fall. In that case, we're going to take a loss on our position. How much of a loss? Well, with a long position, the loss is limited by the lowest price attainable in the market. If you remember in our case, the lowest price is going to be $20, but in the real world, a stock can actually go to $0. So the most you can lose is all of the money, whatever you've paid for that stock. We can mitigate this risk somewhat by selling shares as we go along. Instead of continuing to acquire a larger and larger position, hoping that the stock will reverse itself, we can mitigate our risk and mitigate our losses by selling off a little at a time. Remember, the smaller the position, the lower your overall risk is going to be. Let's take a look at an opposite strategy, what we call taking the short position. In the short position, we believe that the final price will be lower than the current market price. We call this going short or to go short. And how does this work? We essentially reverse the order of the operations. Instead of buying low and selling high, first we sell high, then we buy back at a lower price to lock in our profit. We can also sell high and hold that short position and then capture profit at the end of the case. For example, if we believe that the stock will go even lower in price, we might short at, say, 22.15 and then try and buy back the stock at a lower price at, say, $22 or even $20 if we feel that the stock is going to continue to fall. Let's look at the mechanics because this may be a little less intuitive than the buy low, sell high, long strategy. Here's what we do. Again, the market is around $25 a share, and we believe that the final price will be lower than $25. So here's the mechanics. We're going to borrow 2,000 shares. Don't worry for a minute who we borrow them from. The broker that we work with will lend them to us. So we're going to borrow 2,000 shares and we're going to sell them at $25 a share. The good news here is that our cash position goes up immediately. 2,000 times $25, we get $50,000 added to our account. Again, we're ignoring the trading fees for right now. However, our share position becomes minus 2,000. Why a minus? Because we've borrowed 2,000 shares. We've sold something that we do not own. So we get a lot of cash, $50,000, but our position is minus 2,000. This is to indicate that we owe somebody these 2,000 shares. Now the market has fallen in price. We've gone from $25 down to $24, and we'd like to lock in some profit. So we take some of this cash that we're sitting on here, and we buy 1,000 shares at $24 a share. We call this covering your short position, by the way. So what happens? The cash position, which was $50,000, goes down by $24,000. So we're taking $24 a share out of our account to buy these shares. So 50,000 minus 24, we end up with 26,000. What about our share position? Well, we were at minus 2,000. We've just bought 1,000 shares, so that's brought us up to now a minus 1,000. We still owe somebody 1,000 shares. Our realized profit and loss is now $1,000. If we think of it this way, we sold at $25 a share, and we bought back at $24 a share. The difference, $1, we get to keep. So that part of the profit is locked in. we still have an unrealized profit of $1,000 because our position is still minus 1,000 here. We still have 1,000 shares outstanding. If we bought 1,000 shares immediately at $24 a share, we would realize this profit. Now let's assume that the market falls even further. Suppose now it's down to $23 and we see a good opportunity to lock in our profit and again cover our short position. We'll buy 1,000 shares at $23 a share. What does that do to our cash? Well, remember, we had $26 that was left in the cash position. We're going to use 23 of that $1,000 to buy our 1,000 shares, and that leaves us with a balance of 3,000. Our share position, because we're buying 1,000 shares, will come up from minus 1,000 up to 0. So we've effectively closed out our short position. We've completely covered our short position. What about our profit? We now have realized a profit of $3,000. Our unrealized profit is 0 because we have no more open positions. So this would be the mechanics of a successful short position. Now let's talk about the risks of the short position. In a similar way, where we were concerned with prices falling with the long position, in the short position, we're concerned when we sell high but the market price continues to increase. In fact, the loss in this case is theoretically unlimited, and this is the same as in real life. If we sell high but the market price continues to go up, we'll have to come up with an increasingly larger amount of cash to cover our short position. Well, just like with the long position, a way to mitigate risk is to buy back shares as you go along. Instead of continuing to sell high and continuing to increase the short position, we can mitigate risk by buying some shares back as we go along. Remember, just like with the long position, the smaller your short position, the smaller the risk will be. Now I'd like to talk a little bit more about the simulation details. Each trading round is going to last for 10 minutes, so we have a lot to get through within 10 minutes. Information about the analysts will be released at the 2-minute, 4-minute, and 7-minute mark. Each trade that you carry out will come with a 1 cent per share trading fee. Think of this like a commission. So each time you trade, whether you're buying or selling, you'll be charged 1 penny per share, and you'll see that in your accounting statement. Traders taking a long position may borrow up to 50% of their position on margin. This means that if they go to buy 1,000 shares, we can loan them, the broker will loan them up to 50% of their position on margin. Traders taking a short position will have 150% of their position encumbered, that is, held aside to cover their short position. If we think about it, the broker needs to make sure that anyone who enters a short position will always have enough cash on hand in case the market price should increase. And so by encumbering or setting aside 150% of the dollar value, the simulation and the broker can ensure that you'll have enough cash on hand to cover your short position no matter what happens. As a result of this, between the margin and the encumbrance, you can do a lot more going long than you can going short with the available cash that you have. The next step is going to be setting up your order management system. And to do this, your instructor will point you through which application to run and then which windows they want you to open up once the simulation is running. For example, one of the things we'll need is the portfolio, which will show our current position, that is the number of shares that we have, as well as a snapshot of the market, our realized and unrealized profit and loss. The book trader is going to give us the depth of market, that is the list of all the limit orders that are currently active in the market. The transaction log will give us the debits and credits to the dollar values in our account, including the commissions that I just mentioned. We'll probably want some charting, and so there's a security charting feature that will give us some candlestick charts that let us know where the market is going. We've got an order entry bar, which I'll explain in a minute, which allows us to do the buying and selling. There's a trade blotter where our open limit orders will sit. And then finally, there'll be a news window, and here's where the information about the analysts will come through. Final note about entering limit and market orders. Here's a snapshot of the current limit order book that's in the simulation. In order to put a limit order into the market, we're going to use the buy and sell order entry bar. Our ticker should always be GTT. This toggle button should say buy. We'll be prompted for the volume, that is the number of shares to buy, and we'll be asked for a price. The LMT here indicates that it's a limit order. In this case, I've chosen a limit order, $23.92, that will come in hopefully at the top of the book. So by clicking the Submit Buy button, this limit buy order will enter the book at $23.92, and it will be the best bid in the market. A limit sell order will look exactly the same. The only difference is we'll click this buy button to toggle it to a sell, and then our order will come in on the other side of the book as a selling order. For a market order, in the event that we want to trade right away, we simply click the LMT button to become MKT, and you'll notice that the price goes away. In this case now, a market buy order for 1,500 shares will immediately trade with the best asking price in the book. If no other orders enter the market and I click Submit Buy, we would purchase 1,500 shares at $24.33. It would be an instantaneous purchase on our part. A market sell order will work exactly the same way. We click the buy button to become sell, only this time it will work on the other side of the market. We'd sell 1,500 shares, we would get a partial fill at $23.91 and a partial fill at $23.86. So, with these mechanics out of the way, hopefully you have enough information about the case and you will be ready to trade. Good luck to you all.